Hello friends, Chris Lee, CPA here, back with another video for you. And today we are going to talk about the fundamentals of gift tax and kind of what you need to know about it. So when it comes to gift tax, this is something that most people are less familiar with, but essentially gift tax works, hand in hand with the estate tax to prevent natural person taxpayers from avoiding estate taxes by giving all their money away tax-free during life. So in reality, very few people actually pay gift taxes, but all high net worth people need to high net worth, progressing towards high net worth, Henry's, high earners, not rich yet, or ultra high net worth, or if that's kind of like your goal. Everyone has different values, but if that's kind of the goal and the trajectory you're going, you need to be aware of gift tax and estate tax and kind of how they work together at a at a basic level. So to start off with, we have to define what is a gift. A gift really occurs when someone gives money or property for less than it and for less than its full value or for nothing. So essentially it doesn't matter if you intended there to be a gift. It really just matters if there is a bargain element to what the giftor, the giver of a gift, is providing to a giftee or recipient of a gift. So and it can be anything that is less than its full value. So any type of tangible or intangible property can be a gift, and this can include cash, stock, crypto, real estate, art and collectibles, business interest, vehicles, loans that have that are interest free or have a undervalued or understated interest rate compared to the applicable federal rate, the AFR, forgiveness of a debt, signing away life insurance policy beneficiaries to another person, those sorts of things. So there's basically really anything that has value that you transfer for less than that full value in exchange is potentially a taxable gift. So you can give a gift to anyone, and this is to say natural people. Corporations don't really give gifts in the same way that for estate tax purposes, because businesses are presumed to have kind of like an indefinite life, whereas people aren't assumed to have that. So anyway, most of this context comes from the idea of a natural person giving a gift. So I want to lay that foundation work as well. So you can give a gift to anyone. It doesn't matter if it's a child, grandchild, niece, nephew, whatever. There's no legal limit on how much you can give. There are just different limits at which there are tax consequences or reporting consequences. So you can make a gift directly to a person without a restriction. So that could be, writing them a check or giving them cash, which is, the simplest type of gift. And you lose control over that property that's involved with that. So when I say property, that can refer to, liquid assets of cash or something, or it can be illiquid assets. That would be like real estate or something of that stage. So for this reason, gifts are often made through various types of trusts when you're giving up control, potentially giving up control. So you want to put restrictions on that. So a lot of times people will use trusts, and when you provide assets to a trust to kind of fund the trust, it is treated as a gift to the beneficiaries of the trust. The beneficiaries are the people that will receive the benefits of the assets of the trust at some point. So irrevocable trusts. So this is where we kind of have to talk a little bit about trusts sometimes. And so a lot of times we use irrevocable trusts to provide our estate tax benefits that we're looking for, and we'll get a little bit more into how they all interrelate in a couple minutes. But irrevocable trusts are trusts that you can't terminate or change, and it allows giftors, people giving gifts, sometimes referred to as the donor, to remove assets from their estate while maintaining control over how and when beneficiaries will receive those assets without them having to be used today. So such trusts have complex rules sometimes, and so what the what those will look like. There are all sorts of irrevocable trusts that exist. Most irrevocable trusts, well, I won't say most, but irrevocable trusts, usually we're thinking them as its own separate entity that's going to file its own return. It's not treated as quote unquote a grantor trust, which is kind of like the concept of a disregarded entity for when we talk about LLCs. A grantor trust is what you can sometimes see with a revocable trust, which is you can easily change, terminate, do whatever you want. And because of that, it has no estate tax consequences. Irrevocable trusts do have, can have consequences, and usually consequences that you're looking for, beneficial consequences for your estate. So irrevocable trusts, most of the time, the goal is estate tax purposes, and they might be a taxable entity, sometimes they're not. If you have what's referred to as an intentionally defective grantor trust, that's usually like where you're getting an irrevocable trust for legal purposes and estate tax purposes, but for income tax purposes, it's going to be disregarded. But all of that is like a way more complicated question around trust taxation that maybe a video can go into at some point. So first thing is gifts are not taxable income to the recipient. So even if it's counterintuitive, but if you've got gifts that are not taxable income to the person to receive them, there's no reporting requirement for the person receiving the gift. So that person doesn't really have any consequence on that front. So they're tax-free to the recipient, and the gift recipients don't need to report gifts on their tax returns, right? Like on their income tax returns. So if a recipient later sells the gifted property and earns some sort of profit, the profit is, taxable to the recipient. And usually it's taxable as though they had the same quote unquote basis in the property that they received as the person giving the gift. So if someone, say it's a car, let's assume it's a classic car, okay, that maybe goes up in value. If someone gives a classic car to their kid or something, and when it was given, it was worth $50,000. All right, it was worth $50,000, but the gifter had paid $30,000 for it. Okay, so it's got $20,000 of appreciation. Then the giftee, the person that received the car, when it was worth $50,000, takes hold of the asset, and then 10 years later sells it, for $70,000. So that's appreciated. Instinct might say that, oh, the gift is, it's how do we calculate the gain on that 70,000? Instincts might say, oh, well, it's only the 20,000, the difference between the 70 and the 50. The 70,000 seller price and the 50,000 of the date they acquired it, that's their gain. Not really. Usually it's the basis of the giftor that you step into. So it's really the 70 minus the 30. So your gain could end up being, $40,000, not $20,000. And it's important to note that a lot of times gifts are going to be treated as long-term. And for gifts also, they're usually capital assets. So long-term capital gains aren't the worst thing in the world. It's just something to, be aware of. Gifts to individuals. So here's kind of the next thing we need to know. So gifts are not taxable income to the recipient, and they're also not tax deductible to the giftor, the donor, the person giving the gift. So gifts to individuals are never tax deductible. You basically need gifts to be to a qualified charitable organization to be deductible, which is to say it's not to an individual specifically, and then you can potentially deduct that gift on your tax return. Usually you would need to itemize to see the benefit of it. So when it comes to the federal gift tax, it exists to prevent, again, tax-free transfers of limitless amounts of wealth while people are alive, right? So people accumulate massive amounts of wealth, and the gift tax, and basically the idea is if gift tax didn't work, we've got all this wealth, people would be getting the assets transferred out of their name while they're still alive to avoid, a taxable estate when they pass away, because estate taxes range from 18% all the way up to 40%. So they're pretty high tax rates. And when it comes to estate tax, the big problem is that you're not only taxing liquid assets, you're taxing illiquid assets, but you can only satisfy the tax obligation with your liquid assets. And so you have substantially appreciated or substantial assets that are non-liquid assets, that becomes a problem that you kind of have to solve for. Usually you might use, certain life insurance policies to do that. And life insurance policies named to a trust to avoid estate tax consequences, but different topic anyway. But when it comes to the gift tax, works to make sure that when you've got to kind of be a backstop for the estate tax. If the estate tax encourages people to give away assets during their life to avoid that tax, we've now got the gift tax in place to make sure that that those transfers during life don't go tax-free, to avoid the estate tax. So the two kind of work together. You get your exclusion of estate and gift tax, your lifetime exclusion, and you start tracking that exclusion during life under the gift tax rules. And then when you pass away, the available exemption transfers to your estate, and then you determine whether or not you have any tax consequences there. Now it's important to note that not important to note, few people actually pay gift taxes because the exclusions and exemptions are, work pretty well. And that is to say, it's sometimes just a tracking mechanism, and we just have to be aware of the fact that we might have a filing or obligation for, an annual gift tax return to track our, exemptions, right? To make sure that we're tracking against our lifetime exemption. And so this will make a little bit more sense in a few minutes when we talk through some examples. So the annual gift tax exclusion, it allows, a person to give a limited amount of money or property to any number of people during the year without triggering gift tax consequences. So it's the idea of like, birthday presents, all those sorts of things that you might give to people. You basically can exclude up to $19,000 per person every single year and have no reporting responsibility. So this means you can give 19,000, and this 19,000 figure is the same for 2025 and 2026. So we're in kind of the same boat, but basically this means you can give up to $19,000 to as many different individuals as you wish during the tax year without having to file a gift tax return or pay gift taxes. And then gifts that are, use up the annual exclusion, they do not reduce your lifetime estate and gift tax exemptions. So this is to say, let's take John, let's assume he's got 4 kids. You can give up to $19,000 cash during the tax year without, having to do anything, report on a gift tax return or anything like that. So basically, John can reduce his estate by the 19,000 times 4, which would be close to, what is that, $80,000, somewhere in that ballpark. And then if you're married, what's interesting to note, so that's John being able to reduce his estate by $80,000 without having to even file a gift tax return. If you're married, you and your spouse can combine your annual exclusions. So say John is married to Janet, you can have John and Janet, they both have that $19,000 exclusion available in a year. So that makes it $38,000, and they can do a process of what's called gift splitting. So this doubles the amount a married couple can give to each recipient to $38,000, and using an exclusion amount. So gift splitting allows, even if the gift comes from only one spouse's assets, both spouses can consent to gift splitting. It will allow the applicable gifts during the year to fall under the exclusion amounts and not use up the lifetime estate and gift tax exemption. So let's assume John and Janet are married with, 3 children rather than the 4, and they may give each child, $38,000 during 2026 without any gift tax consequences. Gift tax consequences that go into using up their exemption. They do have to file a gift tax return to elect that splitting, and they should file 2 individual returns together to avoid correspondence or something from the IRS. So you actually want to have John and Janet's gift tax returns together when you send it to the IRS, because it will make processing easier. So the annual exclusion, it's important to know it's use it or lose it. So if unused exclusions do not carry forward in future years, it's kind of like 401k annual contribution limits. If you don't contribute during the tax year, it just goes away. That's the same for the annual exclusion. If you don't use it, it goes away. It doesn't carry forward. Now, if you have gifts that are in excess of the annual exclusion, then you will need to file a tax return to start tracking against that lifetime estate and gift tax exemption. Okay, so basically what happens is during your life, you have the annual gift tax exclusion, and then you have a single unified lifetime estate and gift tax exemption. So the exclusion is an annual thing. The exemption is your, lifetime availability. So the lifetime exemption is the total amount you can transfer during your life as gifts and at your death through your estate, free from federal transfer taxes. So when we think of kind of gift and estate taxes, we call them transfer taxes. And so this is the two together kind of work during your life and during your death. So the unified exemption effectively shields a big portion of wealth from transfer, from taxation. It doesn't shield it from reporting, it just shields it from actual taxation. So the lifetime exemption, following the One Big Beautiful Bill Act, the OBA, is $15 million per an individual and $30 million, per married couple. You can transfer up to that total amount during your life and at death without incurring, a transfer tax liability. Gifts exceeding the annual exclusion count against your lifetime exemption. So when you exceed the exclusion, you may not owe the gift tax immediately, but you're reducing the amount you can transfer tax-free at death. Okay, so you're still going to be required to file a gift tax return in order to substantiate that you what the amount of the available exemption is to your estate because of the gifting you've done during your life. So assume during 2026 you've got, again, John and Janet, they gift their grandson $100,000 to help him purchase a home. Since the gift is $62,000 over the combined annual exclusion, which is the $38,000 for John and Janet together. If they choose gift splitting, they must report it on a gift tax return. The gift reduces the lifetime estate and the gift tax exemption by the $62,000. So they get the $38,000 annual exclusion. $100,000 is what they gifted. $62,000 reduces their lifetime exemption, the lifetime estate and gift tax exemption, from 30 million and reduces it by the 62 million. So they go to 29, not much less, but you still have to track it. So the IRS tracks these taxable gifts using a gift tax return known as a Form 709. If your total gifts are going to exceed the exclusions plus the value of estate tax when you die, I'll say this: if your total taxable gifts plus the value of your estate when you die exceed the lifetime exemption, the excess is going to be taxed, in according to the kind of the estate tax brackets, which range from 18 to 40%. So, that's something you've got to think about. So assume you've got a single man, he gifts, let's say he gifts $2 million over the annual exclusions during his lifetime, okay? And he leaves an estate that is worth, 14 million when he dies, okay? So his total taxable gifts during his life were 2 million. His taxable estate when he died was 14 million. That means his gifting and his net worth on his death totaled 16 million. That means $1 million is going to be subject to taxation, and it will fall into the tax bracket range. So if you give more than your lifetime exemption while you're alive, any additional gifts are going to be subject to gift tax. So that's the like most important thing, absent any discussion of, annual exclusion. But if you use up all of your exemption during life, that means all the subsequent gifting will be subject to tax. So there are certain gifts that, no matter what happens, even if it's over the annual exclusion, they are tax-free. So this can include gifts to charity, which would be, 501c3 organizations. This could be gifts for tuition. So gifts of, tuition are free of gift tax if they're made directly to the educational institution. So, and this can be if the student is full-time or part-time, but it doesn't apply to books, supplies, dorm fees, all that sort of stuff. It's just tuition directly to the educational institution. Medical expense payments are also tax-free, so from gift tax, and so no gift tax is due if you pay a medical provider directly for someone else's qualified medical expenses. So if you make the payment directly, not to the individual or the patient that's involved. So these medical expenses include any expense that would be deductible as an itemized medical deduction. Gifts to spouses, there's an unlimited gift exclusion. So transfers between spouses who are U.S. citizens are, go tax-free, so that you can go back and forth on that. And then you have gifts to political organizations. So there's no gift tax due if it's to a qualified political organization, and it needs to be for political purposes. Now, as noted, the gifts to spouses applies only to U.S. citizens, so that the unlimited transfers tax-free to spouses is only for spouses that are U.S. citizens. If they are not U.S. citizens, for 2026, the annual exclusion is $194,000. It's important to note that if you've got a spouse that is not a U.S. citizen, there are some significant consequences you need to think about from a gift tax perspective and an estate tax perspective, and some meaningful planning to go on there, because the exemptions are not the same, and it does not work the same if you've got a non-resident or a non-citizen U.S. spouse. There's just things you have to consider. So that's an important distinction to know, is that most of this gifting, or like when we're working with spouses that are U.S. citizen versus not, there's a lot of things to consider on that front. So now there's one other, an additional note when it comes to gifting, is the idea that the annual gift tax exclusion only applies to what we refer to as present interests in property. And that is to say, a person who receives a gift has the right to use it immediately. So that's what the annual exclusion, that $19,000 threshold, $38,000 for married couples, that's what it applies to, present interest only. If it's a future interest, then the annual exclusion will not apply. So this is to say, these are, if it's a gift to someone can use in the future, not when the gift is made, do not qualify for the annual gift tax exclusion. So these are called gifts of future interest, and they are going to have to be reported on the 709, which is the gift tax return. So let's say someone puts, let's say $30,000 into an irrevocable trust for their niece, and at age 25 can use that money in the trust. Let's say you gift it and the person's 25 and you can't use it until they're 30. The gift is a future interest because the niece or nephew or whatever doesn't have right to the money now, and so the annual gift tax exclusion does not apply. And so you're going to have to disclose it on a gift tax return, and it's going to reduce your lifetime estate and gift tax exemption. So it's important to note that, when we're doing a lot of estate planning, we use a lot of lawyers to do that sort of work. And lawyers have, used various methods to get around the present interest rule and get the annual exclusion for a gift placed into a trust. One of the primary methods is using what's referred to as a crummy trust. And so this is basically an irrevocable trust that gives a temporary right to withdraw the contributed asset to the trust. So this might be 30 days or 60 days. Just by design, the beneficiaries don't withdraw the gift. They let it lapse, and they let the period of withdrawal lapse and leave it in the trust. And so because the beneficiaries had a present right to withdraw the money, not that they actually did, it qualifies as a gift for present interest and gets the present gift exclusion. So that's what a crummy trust will do, and lawyers will use it. Next thing to know is gifts to minors. So they cannot be, by law, minors cannot receive a full present access to or control of gifted property. So, but there are some present interests that qualify for the annual exclusion if 3 conditions are met. The first is that it's retained in trust or a uniform transfers to Minors Act account for the minor's benefit. So that's rule 1. It needs to be in a trust or an UTMA account, uniform transfers to Minors Act account. The second is the remainder of the gift must go outright to the child no later than the age of 21. But you can give it to the child between ages 18 and 20. And 3, if the child dies before reaching the age to receive the gift outright, the remainder of the gift must be paid to the child's estate. So it needs to go to a trust or an UTMA account. It needs to be paid out by 21. And then it can also be paid out if you choose between 18 and 21. And then if the child were to die, it needs to be paid out to their estate immediately. So those are the rules around gifts to minors that allow them to receive a the annual exclusion. Otherwise, it's considered a future interest because you're not allowed to gift to a minor, and therefore it's reportable on a gift tax return. So when it comes to valuing gifts, it's generally the fair market value on the date of gift, which makes it very easy for publicly traded securities or crypto or something like that. That's very straightforward. However, if you're using gifting to gift, real estate, art, collectibles, intangible assets, business interests, that sort of thing, it becomes much more difficult. Usually when we start doing gifting, you can have the fair market value, but you'll use what's called valuation discounts, which you use to decrease the value of the gift for gift tax purposes, which helps preserve the lifetime estate and gift tax exemption. And you do that through discounts for marketability, or if you've got a minority interest in a business or something like that. So these are the strategies that professional appraisers would use, and that's kind of like working with them to make sure that they're doing all the considerations that will give the gifter the best benefit for purposes of reporting on their gift tax and preserving their lifetime estate and gift tax exemption. So when it comes to gifting, our primary strategies are giving away now not only excludes your present worth, but we need to think about that it's it's removing the future appreciation on your assets from your estate. So the asset that you have today isn't necessarily what it's going to be, when you die. And so for estate tax purposes, you're looking at the fair market value on the date of death. And so if you're currently under, say, the 30 million threshold that is, for a married filing joint couple, but you're 30 years from retirement and you've got, maybe a $10 million net worth, that's something you really have to think about is what is this going to look like in 30 years when you might pass away. So if you're worth $10 million and you're in your 40s or 50s and you're going to live to your 80s, I mean, understanding that the exemption might go up, however, your assets might go up faster than the exemption, which actually is like kind of the case. There's like a whole research into all of that. But anyway, it's just something to think about, that like, how do we get these out of your estate? Because we don't want all of that appreciation on a 10 million to, grow faster than the estate tax exemption. And then you have, an estate tax problem when you pass away. So that's one of the things to think about, is getting that asset out of your estate sooner rather than later, because you're getting all of the appreciation out of your estate as well. So, and then on the other hand, when it comes to gifting, you do not want to give what is called already appreciated value. And the reason for this is because the person receiving the gift steps into a carryover basis on the assets that you give, not the appreciated value. And so this is back to the classic car example at the start of this. And so you're giving an asset that is, you don't want to give the appreciation because you're really just, the recipient of the gift will have the same tax basis in the property as the, the giftor, and the person who inherits an asset, on the other hand, through gifting, it's a carryover basis. Through inherited assets, it's a stepped up basis. So if you died and the asset in the car was worth $70,000, or if you died and the car was worth $60,000, and then they sell it in a few years for $70,000, they get the value of the asset on your date of death at maybe $60,000, and then have a $10,000 gain versus, the value of the asset on the date of the gift. They would take the carryover value, that $30,000, kind of thing back. So the important thing is to not forego the benefits of the stepped up basis rules that happen when we talk about estate tax. So kind of going back to it now, the 5 takeaways for this is that just remember that a gift occurs when you give money or property for less than full value. It's a very broad definition. So if you're working with a tax professional and they ask a question about giving gifts, know that it's very broad. So there's no annual limit on giving a gift. There's just an annual limit for exclusions. So gifts are not tax, exclusion from having to report on a gift tax return. For 2026, that's $19,000 for individuals, $38,000 for married couples. Gifts are not taxable to the recipient, and they're not deductible by the person giving the gift, and with the caveats that it's for the 501c3 organization. When it comes to federal gift tax, they range in, from the amount of tax rates from 18 up to 40% for gifts that exceed the lifetime estate and gift tax exemption. For 2026, that's 15 million per an individual, or 30 million for a married couple. And so it's important to know that certain types of gifts are not going to be subject to gift tax at all. Gifts to charity, payments directly made to educational institutions, payment of medical bills directly to the medical provider, gifts between spouses where the spouse is a U.S. citizen, and gifts to political organizations. So those are the most important things, to think about. And so hopefully it's a long video, but hopefully it's helpful walking through the fundamentals of gift tax, which also gives some of the fundamentals of estate tax. But anyway, that's all I've got for you now. Back with a new video for you soon. If you want to connect and chat about anything, feel free to book a call using the link in the video description. Take care. Be back soon.